Thank you all for coming. My name's Jamie Woodwell. I'm Vice President for Research and Economics at the Mortgage Bankers Association here in town. And today we're here to talk about commercial real estate finance, or CREF. So I think most of you probably got the emails talking about CREF Careers Forum. And what we want to do is just present you with a view of the industry, about the industry as a whole, about sort of what it's like to work in the industry, about internships, jobs, and careers, but really about what it means to be in commercial real estate finance. So a little bit, just a few factoids about commercial real estate finance. If you're not aware of it, it's the way we finance everything from apartment buildings to office buildings to shopping malls to wineries. There's $2.6 trillion in commercial and multifamily mortgage debt outstanding. And last year, commercial multifamily mortgage lenders lent $358 billion in commercial mortgages. So it's a big and it's a growing industry. We're really excited about the forum. We had about 200 students register. We've got a great set of panels and panelists, which we'll meet in just a minute. To get things going, I'm going to be acting as the MC tonight. But we want this really to be about you. So if you've got questions as we go along, please ask. We've got microphones in the aisles to try and keep things going. But also, if you can't get to it and you want to raise your hand, please do. And before we begin, I want to thank our sponsors. So we had 12 firms, 7 Washington area universities help pull this together. The 7 universities: American University, George Mason, George Washington, Georgetown, Howard, Johns Hopkins, University of Maryland. Really just great effort. Thanks to the professors, to the real estate clubs, to the career centers for getting the word out. Also then we've got 12 firms that are sponsoring it. They're responsible for the panels, they're responsible for the reception afterwards and the job fair, for the food, for the drink. So really want to thank them as well. We've got Arbor Commercial Mortgage, Berkadia, Berkeley Point, Capital One, CBRE, HFF, KeyBank, Prudential, Red Mortgage Capital, Walker and Dunlop, Wells Fargo. These are really leaders in the industry, really great firms, and you'll get to hear more about them as the night goes on. And then finally want to thank Georgetown for providing us with the space, fabulous space both here and upstairs, to put this on now for our second year in a row. And with that, I think we'll dive right into things. We've got 3 panels this evening. We're starting with the leaders panel, where we're going to be talking to industry leaders about the industry and sort of their views of it. We're then going to be moving on to a colleagues panel, where we'll be talking to folks who you can view as your future colleagues in the industry. And then we're going to be talking to some recruiters about sort of tips, what it's like to come into the industry, what recruiters are looking for, that sort of a thing. But to kick things off, we're going to start with our leaders panel. And what I might do is ask each of you to introduce yourselves, talk a little bit about your firm, and then what your firm does in commercial real estate finance, and then about sort of your role within it. Grace, do you want to kick off?
Sure. Grace Huebscher. I'm president of Multifamily Finance for Capital One. Most people think of Capital One as a credit card company, but actually we have a very large commercial bank, and within that, we have a commercial real estate group. And for us, our commercial real estate portfolio is about $33 billion, and 2/3 of it is multifamily. And within that multifamily business, we do all kinds of things on balance sheet lending, agency lending, Fannie, Freddie, FHA. That's pretty much it.
Okay, sure. So I'm Dan Heberle. I'm with KeyBank. KeyBank is a $100 billion regional bank headquartered in Cleveland. We cover on the corporate banking side probably 7 or 8 different verticals. They would include real estate, but in addition to that, all the ones you'd expect for a bank: technology, utilities, oil and gas, industrial, consumer. Real estate's our largest line of business. We're about $20 billion in balance sheet assets. My role at Key is I'm the head of our institutional capital group, which provides finance to kind of the corporate entities within the real estate space, both on the commercial and the healthcare real estate side. Together with our investment bank, the real estate line of business in our investment bank really faces the market on a pretty broad basis. We can do everything from construction lending to credit facilities, term loans, M&A, advisory business, taking companies public, really just about every angle that you could think about in the real estate finance Key can provide to our customers. That's about it.
My name's Sheri Thompson. I work for Prudential Mortgage Capital Company, which is a wholly owned subsidiary of the Prudential, or you guys probably know it as just the Rock. Prudential Mortgage is a wholly owned subsidiary, and it is where all of the real estate holdings and business is conducted through. We do billions of dollars annually in production for commercial real estate. We have a wide array of products and services that we offer, very similar to what's been described before. We do debt, equity, we have CMBS, life. The predominance of what we do is life company. I actually work as the Chief Operating Officer for the agency lending group, which is mostly the Fannie Mae, Freddie Mac, FHA, and balance sheet lending.
I'm Sue Carras, and I am the Senior Managing Director, co-head of the HFF office in Washington, D.C. HFF is a capital markets intermediary, and which is kind of a trick name. I don't know if you guys all know what that means, but we are a broker, for lack of a better word. We're a publicly traded company on the New York Stock Exchange. We have 23 offices around the country. We just opened an office in Charlotte, so on the East Coast we have Portland, Boston, New York, New Jersey, Philadelphia, which is another new office of ours, Washington, D.C., Charlotte, and 3 offices in Florida, and we have Atlanta also. So those are all possible. I don't know if you guys are regionally interested in the East Coast, but that's something to think about. We did about $55 billion in volume last year in 1,600 transactions. Those transactions break down about half into mortgage originations, placing mortgage originations primarily with banks and life insurance companies, also with the agencies. And then the other half of our business is investment sales and equity placements. We do joint ventures for existing projects and developments. We're broken down by product specialties. We have office investment sales, multifamily, industrial, retail, senior housing, student housing, credit tenant lease, retail, I said that, industrial, and I think I've covered them all. So there's lots of opportunities at HFF and you guys are all around the country, so happy to talk to you, and we'll be upstairs too, so.
Great. So digging a little bit into that, and we talked about some of the volume numbers and number of transactions, and so to get a sense of what is a transaction. So Grace, when we talk about a deal, I'm going a little off script here, but if we talk about a deal, so what would a deal be? It's say a multifamily, an apartment that's being financed, the owner's coming looking for financing for it, either to buy it or to rehab it.
So a typical deal that we come across would either be an acquisition, so there's an owner of a property and they're selling their property, and the winner of that is going to be looking for a way to finance that loan. So they'll come to any one of us and say, they'll talk about what their plan is for the property. And you really have to listen to that carefully, because that helps you tailor what kind of financing they might need. So for instance, if someone's buying the property and they're going to put a lot of rehab into the property and fix it up, that means they're going to have a pop in rents and income and value, and they want to be able to capture that in a form of debt. So what they might do is do a floating rate loan and as an interim step, and then wait till they really realize the full value of the value and the rehab that they put in, and then later finance that with a fixed rate loan. So that's really key. You have to listen to what the borrower their plans are for whatever financing they're asking you for, because you really shouldn't be thinking about products. You should be thinking about what is the solution this borrower needs to accomplish what they need to accomplish. That's kind of an often made mistake when you get into this business, is to think it's product driven, but it's really financial solutions driven.
Yeah, I would echo what Grace said, and one of the other things, kind of big picture, when you think about real estate in the industry in general, I mean, real estate's a tangible asset, right? I mean, as Jamie said, it's an apartment building, it's an office building, it's an acute care or long-term acute care hospital. It generally has cash flow coming off of it. once it's built and stabilized. So you don't really have to have new construction, and I think that's one thing that's interesting to point out. So you don't have to have new buildings being built for this industry to be very active and us on the finance side to be very active. As Grace noted, when a property changes hands, there's almost indefinitely a new capital structure that needs to be put in place for that property, and that's a combination of debt and equity, as Grace noted. So that's an interesting aspect. The other thing I'd say, Jamie, is when we think about transactions, at least in the group that I run, a lot of times it's not necessarily project focused, it's corporate focused. So you'll have a company buying another company, and they'll come to us as their bank partner and say, listen, we need capital. We need a backstop of $500 million, $700 million, whatever the number might be, so we can make this acquisition happen. We're a public company. If we announce it, it's an 8K event, which just means they have to disclose it to the public, but they can't disclose it until they know they have the committed financing in place. So a lot of times when we think about a deal, it can be, kind of corporate M&A as much as it can be project specific. That's another angle to think about it.
Mm-hmm. Sheri or Sue?
Grace, I think you did a good job explaining it. I would just give you some general parameters of if you're talking dollar-wise on a commercial project. I mean, they can run, anywhere from $500,000 to $1 billion, to $2 billion, to $10 billion. But I think the average that most of us look at is, $10 to $20 million deals is that's probably fair. I mean, we all see our range of smaller, and then the very large deals are obviously the ones everyone chases. But that's kind of the normal area in which you're looking at a transaction. And then, in terms of where it fits is a lot driven not only by what the borrower wants, but by the specifics of the real estate, and the various aspects of the real estate are going to drive which capital source it fits best in.
So everybody has said what I think too. Thank you very much. Grace said, we always think in terms of you tell us what you want to do and we'll arrange the financing for that business plan. And that's the words right out of our mouths. And whether it's debt or equity or it should be a sale is how we approach it at HFF. As an intermediary, we are a little bit different because we're taking your idea and then taking it to the debt market to see where the best execution could be, some of which is strategic thinking. And then at the end of a process, a lot of it is competitive bidding. And we were just talking about it before, we're in a very competitive market right now where there's a lot more money than there is product. And so you're getting lenders who are willing to really compete down to maybe 3 rounds of bidding and improving terms each time. So I don't really love that, but it's good for the client, and what are you going to do? But if you take our $55 billion and you divide it by 1,600 transactions at HFF, the average deal size is $34 million. Most deals are not the average. They're either big or little. DC is a kind of a market where transactions tend, in our world, to be between 30 and 100 million. And not much bigger because our buildings don't get that much bigger here in DC, especially, the office buildings don't get big like they do in the other cities where you have high-rise towers. But I will digress for 1 second to say, because you were saying, the great thing about real estate, it's a tangible asset. You can drive by it. I still go by buildings I financed 30 years ago. I just was called by my first client ever from 1983, and we reminisced about the building on Rocky Point in Tampa that we worked on together as a joint venture. So that's the great thing about real estate as a career is you make tons of friends. In fact, all my friends are in real estate, I almost can say, because it's a career that you live and kind of breathe every single day, and you work late, and you just make lifelong friends. So anyway.
Yeah, so I'll give you the first word on this next one since you've been at the tail end on the other. Are there other things you tell folks if they're looking at the industry, if they're a prospective hire, to give them a sense of the industry and what it's like to be in commercial real estate finance?
Well, I turn to the panel to see what they think, but for us in our office, we're there all the time. We're there on the weekends, we're there at night, we're there early in the morning, and so you really, really, really have to love this business, and you have to love the collaboration and brainstorming that goes with it. And through collaboration and brainstorming and a lot of hard work come great solutions, and you get to see them built in bricks and mortar. And I can't think of a better industry. I get scared personally. I don't like the concept of fund of funds and all that business because I'm just very concerned. I like to see my money right in a hard asset that I can drive by and look at on the street, so.
Yeah, I would say one thing, as you've probably heard here, it's a very small industry. So it feels really big, and we talk about billions and billions of dollars, but especially, excuse me,
I have the same
as
thing.
you start to specialize, and most people end up specializing in one area or one particular part of finance, the world becomes a lot smaller. And so, you know, from the first job you have to the last job you have, chances are you're going to run into a lot of the same people. And so I would say that remembering that and you know, having that work ethic and that, you know, doing the right thing is really important from day one, because there are people that I still interact with that were at my very first job. So I would say that. I would also agree. It's you know, it's a tough industry in terms of it. There's a lot of work. People put long hours in, but it's really fun. And I think it's fun because while you may be specializing or you may have a lot of different products, each deal is so unique that it's not a cookie cutter. You never are doing the same thing, and it forces you to think all the time about different solutions and creative ideas. And it's although it's numbers, at the end of the day, it's really being creative on how you can service the client best and fit it into the boxes, or maybe stretch the boxes to make the client to meet the client's needs.
Yeah, I think that's. I would agree with that. I think. You know, one point I'd emphasize is the creative aspect of it. I mean, you do have, no matter if you're working on a $10 million deal, $20 million deal, or a $1 billion deal, as everybody in the panel has said, you start with trying to figure out what you start with understanding what the customer's objective is. What are they trying to achieve? And then to differentiate yourself from all the other capital providers out there, we all try to figure out, you know, what's the best way to do that? How can I achieve that while still making sure the risk for the ultimate lender, which in our case is key since we're a balance sheet lender, how do we mitigate that risk and get comfortable with it, and then to still deliver what the customer needs? And there's a lot that goes into that, but it is very much something where every single day, every deal you work on is different. You know, so it's not like and you can always challenge yourself and learn. You don't, after 2 years, you don't know it all. I mean, and I've been doing this for over 20 some years. You know, you learn every day new things all the time. So that's a great aspect of the industry. The other thing I'd say, is, you know, a key in a lot of different places in the industry, and panel members up here too. You can approach the industry on a local kind of community basis or on a national basis. If you want to be involved, you know, in a market and get to know that market like DC or wherever really well, you can become an expert in that market and know all the real estate players in that market and all the projects in that market and be very deep and understand and be able to add value that way. Or you can be, you know, kind of at the corporate level, you can understand capital markets trends. You can be more of a kind of a quasi kind of, you know, corporate finance investment banker expert, where you're giving people ideas on how to raise different types of capital, whether it's equity or preferred or common or go public or sell your company or joint venture. There's a number of different, you know, a number of different ways to think about and approach the industry. And I think that, you know, that level of opportunity, and it's not, you don't just pick one and stick there. I mean, there's, you know, you can start in one place and try and explore different areas within the industry and see what really kind of suits you in terms of your skills and what you like to do and what gets you going in the morning. So there's a lot of diversity of opportunity within the business as well.
Dan and I were actually talking about that upstairs. It's an industry that you get into that has unbelievably broad array of stepping off points. You can go from very large to very entrepreneurial, to very, you know, big companies, small companies. You know, you could, it's just the cast of characters vary from incredibly sophisticated to very scrappy. So, you know, I think that's where the fun aspect comes in. You know, you have to almost be a Sybil, right? You know, to have to, but so there's just, or shrink or whatever, so many different options. The other thing that I was gonna mention, and we've kind of all said it, is that, you know, like when I graduated from college, I had a job offer from P&G, which means I would be pure sales, and one from Data Resources, which was pure economics. And I really was like, you know, naive and said, well, gosh, how can I marry these two? Because I love people and sales, but I love numbers. This is, if that's how you feel, this is a perfect industry for you. The other thing that nobody's mentioned is if you want to make a lot of money, you can make a lot of money in this business.
And why
on
not
that.
make
And
money,
if,
you know?
If anyone has any questions out there, get ready. Maybe, truly, if anyone has any questions right now, if not, oh, question right there.
Hi, my name is Alex. I'm a first-year MBA student at Georgetown. You guys are coming in. Sure, I wanted to ask you quickly, some people were talking about the timeline of the deal on the process. You know, you're saying constantly facing new challenges, all these deals all the time, very exciting, each one's different. Can you talk about the sort of length of the timeline for your deals compared to the development deals you take
Sure.
years, and where you guys fall on the spectrum?
And again, I think a lot of it is driven by the capital sources that you're working with and the type of deal. So if you're talking about a construction loan, obviously from cradle all the way through financing, you can, depending on where you're in your entitlement process, you could be looking at, I don't know, 2 to 4 years. A typical deal that I would do is normally either stabilized or, as Grace was saying, needs some renovation. I actually did a deal here in DC, and I was pregnant when I started, and my daughter was 3.5 when we closed, and that was just
Unusual.
it was unusual, but I mean, it can take a long time, but I would say a pretty standard deal. And as Sue was saying, the competition is so fierce that timing is really critical. And borrowers, they want to be in and out, and the rates are so incredible now, they want to do it quickly. So I'd say from the time you actually hear about a deal to the time it gets signed up can be 30 days or less. I mean, and then to closing is probably, if you're lucky, another 60 days. So for us, we're living with the deals maybe 90 days. If you're talking, and these are all, I deal mostly in multifamily. So, but if you want to look at the spectrum of that's a pretty typical, easy financing. If you want to go to like the FHA route, 12, 18 months can be a normal deal. So I think that it's hard to say, but that for us, I don't know if anyone is doing other product types that has other.
Good synopsis.
Yeah, I think, probably also, I mean, you're juggling more than one deal at a time
Right.
as well. So,
Good
if
point.
there's a deal that you're working on, it's a 4-year process, there's, 80 other deals that you've closed in that 4-year time frame from beginning to end. So you're going to you're certainly going to keep yourself busy with plenty of other things to work on and things that are unique and challenging.
Along the timeline, there are many good and bad surprises usually.
There's always surprises, right?
But you overcome them all
Yep.
eventually, and you get to sit on a panel eventually. So.
This is what you have to look forward to.
Another question right here. First off.
So that's easy for me. It's people who are really, really serious about what they're doing and really care about their work product. And I'll tell you, most people don't. Not at our company, but in general. And if you are a person who genuinely, if you obviously are all smarter, you wouldn't be here. So take that smarts and be the hardest working, most careful person in your company, and you'll become indispensable overnight. Really, and be a flexible personality and a team player. But that attention to detail and the willingness to work harder than anybody else, I think, is the clearest differentiator of who I see become really successful and not. Again, as I said, with this industry, if you don't love it, you probably won't succeed at it, because on the weekends, even if you're not at the office, you should be out driving around. You heard about a project that was starting last week, you really want to go see it, or you heard an apartment building just opened, let me go see if the rents really are what I think they are, and that sort of thing. And so those are the combined talents, I think, that make a good, successful person.
Anything to add, Sheri?
I would echo 100% what you're saying. I think especially starting out, that's critical, is someone who is really has intellect, but the work ethic is important. I think as you see people move up, especially through larger companies, you find that the people have done a varied jobs. So I think that's, getting out and being able to see different jobs, even if it's within your same company, is important. I think it's also being able to manage people and process, which sounds really easy, But when you're a deal junkie, like all of us probably are, it's not natural. So there's that balance of deal junkie and management, and then being able to let go and allow, empower your people to succeed. And that, again, sounds easy, but when you're a deal junkie, you're usually very detail-oriented because you started that way, and getting to that level where you can know that the people you have under you can do that will allow your whole company to be successful.
I agree with that.
Yeah.
Hire smarter people than yourselves.
yourself. Yeah. Or people that work harder than yourself.
Yeah.
Care more.
So the only thing I'd add to that, and I agree, I think one of the things that maybe takes a step back first, one of the things that when you start your careers is important to remember is figure out understand kind of what your employer expects of you, and then what value they're looking for. And this is a lot of what Sue was saying. And then, focus on every day on coming to work to deliver that value. Don't get caught up in, I've seen a lot of people kind of get caught up once they get their first job. They're already thinking about, okay, what's the next role?
Right.
What's my next
Do
step?
everything the best,
Right.
even if it's filling the coffee machine.
Exactly. And if you just focus on the reason they hired you and the value that they need you to bring to the table, and you do that as well as you possibly can, those other opportunities take care of themselves. You need to let people know you're interested in this or that, but that will take care of itself.
And I would add a standout performer in my mind in every step of the way, because there's always problems. I mean, it's a given, is a person who says, here's the problem, instead of just whining and saying, there's a problem, says, here's the problem, here are various solutions to the problem that I've thought about. And by the way, I recommend this solution. And by the way, this is how I think we should go about implementing that solution. Most people don't complete that all the way through those 4 steps. And, I've found the people that actually do that, actually stand out and succeed.
That's so true.
I think I would add one other thing, which I hope I don't insult anyone when I say this, but it can be really challenging to manage people of your generation because you guys have grown up a lot different than people who are in management positions now. And you guys have incredible ideas. And being able to harness those ideas and explain them as Grace described is really critical. But you also got to know when it's appropriate to do that. So we see a lot of people who come in and they work really hard, but Dan, as you said, they want to be at the next step and they don't want to work to get there. And the way to get there is exactly what Dan was saying, but to also throw in when you can, that entrepreneurial spirit that you have that can allow us to get to the next level is when you find someone who has that work ethic who has the entrepreneurial spirit and the patience to kind of pedal gas on it is really a special combination.
So Dan, how did you get into commercial real estate finance?
So when I was in college, in undergrad, so probably around the same age many of you are, I had the opportunity to intern for a different bank, not KeyBank, and this would have been late 80s, early 90s, before any of you were probably born. And we were coming out of the real estate recession and the savings and loan crisis, and the bank that I was working for needed somebody to do some triage in the real estate group. And so for the whole summer, what I did was really sensitivity analysis on projects. It gave me a spreadsheet, and I sat in a cube all day and worked on, if rents go up, what happens to the NOI or the cash flow? If rents go down, if occupancy goes down, what happens to the cash flow? What level, are the expenses fixed or are they variable? How variable are the variable expenses? At what point, just trying to think through different scenarios of risk for that specific project and what that meant to the bank. Was the loan underwater? Were we going to get repaid? What steps should we take and make recommendations on, what to do next, what the strategy would be, and writing memos. And I thought to myself, I learned more in that kind of 2-month period than I probably did in the 3 or 4 years of college I had to that point. It was real life experience. And I was like, wow, this is really interesting. And they were malls, they were office buildings, and different property types react differently. They all have different operating leverage in terms of expenses that can be cut and can't be cut. So when you really, that was the first time in my life where I'd been cutting grass as a landscaper for the summers before that. So this was the first kind of intellectual job I had, and I thought it was phenomenal. It was really interesting. And then I, went back to school that year, graduated, and they offered me a job, and I thought, wow, they're gonna pay me now. This is even better. So it really wasn't any, I think we talked about it. I wasn't, in our generation at least, I wasn't very thoughtful about my career when I was in college. I was just trying to, get through school and, do as well as you can. And but I had never thought to myself before that summer, real estate was I didn't know anything about the real estate industry. So this is the fact that you're here, interested in the space, I think is phenomenal. And having the opportunity to kind of, get a sense for what different types of opportunities are out there is it's much further than I was at that time in my life.
And Sheri, how about you?
I'm one of those odd ducks. I actually have a degree in real estate. I could tell you it's because my father was the CFO of a REIT, which he was, and I got to work there, and it was really cool, and I thought I wanted to be a developer, and I graduated around the same time you did, and there were really no development projects going on. Or I could tell you that, I didn't do so well my freshman year in college, and when it got to picking, majors, it was real estate or logistics, and I thought, I know about real estate. So I got lucky in that I knew the space. And it was a natural progression for me. I worked in the summers in the real estate industry. I worked for a development group. It was really fun. It was great. But just like you, I didn't really have a specific place in the market I knew I wanted to be. I kind of took the only job that I could find that first summer after college. And one of the things, I found a great mentor. It just kind of happened. And through that, had a series of jobs and ended up where I am. But a lot of luck.
So I was a religion major, and I switched to history in my senior year to make myself more marketable in the workplace. So that wasn't very marketable, and by July of the summer after I graduated, I still didn't have a job. And back then, we would wear like a turtleneck and clogs and an A-line skirt to the interviews, which were very professional. So I am here by complete and utter happenstance, and at the, because of the grace of the wonderful mentors I've had in my life, including the guy who hired me at Chase Manhattan Bank, who hired me because I had taken macro and micro and one accounting course. And if you hadn't taken one accounting course, he wouldn't hire you. So that's how I got started. It happened that the job was in the real estate department. It was a job that was combined with college graduates and non-college graduates. And so back to the point we were making before, but that was my ticket into this place. I wanted to be in New York City. I wanted to work in an office and do well. Those were my goals. And so I began to just outperform in my job. And I eventually went on the Chase Manhattan Credit Training Program. I went to NYU's diploma program in real estate analysis and appraisal. I never had a day where I didn't take best advantage of that day. And I continue to do that, and that will set you apart.
How about you, Grace?
So Sue and I know each other, and I'm not sure, did we know that we both went through Chase's credit training program? Oh, we did?
Yeah,
Okay.
yeah.
I'm having a senior moment.
Yeah.
Anyway, so...
We have a lot in common.
When I was telling you about those two job offers at Data Resources and P&G, I just by chance happened to meet the head of global banking who was at our college at a seminar, and I told him about my dilemma, and he said, you need to be in banking. So went through credit training, got the job, went through credit training at Chase. And it's funny, when we were graduating, you could not really pick, but you could almost pick where you could go. You'd have to get hired. And I had no interest in real estate. I wanted to be in commercial banking and lending to corporations, and that's what I did for the first several years of my career. And then one of my clients, I took to the medium-term debt markets to raise corporate money for them. And suddenly someone left running the mortgage company, and they, I guess, liked me and what I did for them and said, will you come on over and run our mortgage company? And I'm like, I don't know anything about mortgages. I don't know anything about real estate. And so he said, well, you're a quick learner. You'll be fine. And so I really liked them a lot. I liked their entrepreneurial spirit, and I did it. And my first week on the job, I was managing people that were 10, 15, 20 years older than I am. And, someone said amortization, and you'll learn this. That's obviously an important real estate term. And I went, what's amortization? Because you don't have that in corporate lending. So that's it was by accident. And I haven't left the real estate business since. I've been in real estate for, 25 years, 26 years.
So I should add that my job interview was part of a rejection letter from the training program.
Wow.
But then I went into it was just chance it was the real estate department, and then they sponsored me, so I had to go back to them.
So there's a lot of serendipity in your career.
A lot
And
of
I think
serendipity.
you need to keep your eyes wide open for possibilities and just keep your mind open, because you just never know who you're meeting or who you're going to run into where an opportunity will come up.
Ted Leonsis actually wrote a great article, which I'll be happy to share, and you could all get hold of it somehow, but it was advice to interns as they were starting their summer internships. It was great universal advice. Arrive early, leave late, say thank you, follow up, write thank you notes. These are all really important parts of the success, too.
Questions? Question right here. Happy stories?
Well, we're all here.
I don't have it all, sir, although.
Well, actually, I actually have a really happy story, and that is I was on the trading floor, capital markets group at Fannie Mae when the debt crisis hit, and I was managing all their non-single family, positions, et cetera. So interestingly enough, we saw that credit crisis, sitting on that desk globally coming well before the average person did. And it was extremely frightening when it hit and, the acceleration of what happened. And obviously, what happened to Fannie Mae. And I was there. So what happened is, the business that I was in, which was multifamily agency business, that business remained vibrant during the credit crisis. So I actually decided to leave Fannie Mae and start my own business with a bunch of partners out of New York. So I think the message there is in every crisis there is an opportunity and you need to look for it. And another way to look at the real estate crisis, you started out saying you were doing some special asset management. In downturns, real estate needs to be worked out. I mean, so there are ways to get through cycles, and well, we're living testament, right? We've been in the business for a couple cycles. So I don't think I would let the cyclical nature of the business, I wouldn't let that scare you.
I'd say think about who you're going to work for and what their capabilities are. Most of us were very fortunate at that time that we were working for companies that had enough, entrepreneurialism that they could move, they could shift, they could, where I worked, we were very fortunate. We had no layoffs, which was incredible. Everybody kind of hunkered down and made some sacrifices, and the multifamily space did operate, very, very well during that time. But I would say, always looking at what's out there in terms of what's coming, as you said, knowing what's there, and making sure that you're at the type of company that you want to be at when that hits. We find that people who move job to job to job just for that extra $5,000 or $10,000 every 2 years, well, when the music stops and we are in that down cycle, those are the people that really are going to struggle more than the people that have been at, more at an organization where they're showing their worth and continuing to move throughout the organization.
So not to be motherly, but when I first went into brokerage, the guy who ran our office, I was down in Miami, he took me into his office and he said, honey, don't have a mortgage and only invest in treasuries because this is a cyclical and tough business. So that's not bad advice. And so if you're going to be in this business and it is cyclical, it's better not to live a flamboyant life and get yourself overextended with your own personal debt and whatnot. So that's just a piece of advice as you go through your own timeline.
It's lucrative, but not every single year.
But I mean, when I started at Chase, it was 1976. We were not in the market making new loans again till 1983. That's how severe the workout of the 74 recession was. And that created the jobs because we needed people. And that workout experience is so fun and so differentiating. And then I took 10 years off to raise my kids in my career, and I came back in 2009 because there were opportunities again because of the downturn, and came back to work on an FDIC contract. So same kind of thing. I knew there would be some change in the market, and new people come in and out at that time too, so it's a good time to establish yourself or reestablish yourself.
Yeah, so when the most recent crisis hit in 2007, KeyBank had probably close to $2 billion of commitments to single-family home builders across the country, large, medium, small. And, as you guys will learn, land goes from being worth 100 cents on the dollar to like 2 cents a dollar overnight.
Kind of like Fannie Mae stock.
Exactly.
It's
So we had to deal with a lot of issues and moved a lot of those loans from the line to the workout group. But I would say from if I was sitting where you're sitting, a lot of the people we moved probably 25, 30 people from the line into the workout group. I mean, our workout group pre-recession had like 2 people in it. I mean, we hadn't had a real estate loan go bad in 20 years in a really serious way. And so
It's going back the other direction, right?
Exactly.
Worked everything out and production's up.
Production's up. So our workout group was very understaffed, and so we moved a lot of people that were kind of 24, 25, 32, had various maybe 2, 3, 5, 7 years of experience in real estate into the workout group, and they'll tell you they spent 3 years there. They'll tell you that was the best training they could have ever had, and they're better production people today and better risk analyst people today than they would have been had that not happened. So there's always, I don't know, Sue, maybe you said it, there's always a silver lining to something like that. I mean, it's never something you want to go through as a economy, as a country. But those folks now are in a Key, at least. We're in the risk. We're a balance sheet lender, so we're in the business of taking risk. That's our money. We lend the money, and we're taking the risk. So having the skill set post crisis to really be able to think, and this goes back to one of the other questions earlier in terms of skill sets. One of the critical things, 5, 6, 7 years into your career at a place like Key, one of the critical things to success is being able to recognize opportunities, because you're going to see lots of things, and you're going to see a lot of deals and opportunities quickly. But to really be able to synthesize which ones are the best risks to take and which ones can make the bank, the shareholders of Key, the most money, those are the ones that you want to focus on. And so having that background of going through workout and seeing the worst of the worst and the darkest days really helps you create that background and that level of comfort to be able to say, yeah, this is a good risk to take. Let's allocate resources to it, go get it. And the other thing I'd say, and we didn't, just going back to the earlier question about characteristics of success, acting with a sense of urgency is really critical. Customers in our space, there's so much competition, but having a fire behind what you do every day is an attribute that will take you a long way in our space as well.
I think we've got time for 1 or 2 more questions. Yeah.
That's interesting because we were just talking about this internally today. I think we think that rates are actually going to stay low for quite a long time right now. If rates do start to rise, where there's questions in terms of cap rate adjustment, there's a lot of run room in the cap rate. So, right now people have a lot of sense of urgency to get deals done. There's a lot of sales transacting. I'm sure you can speak a lot about that. A lot of it is because debt is so plentiful, it's cheap, there's huge competition, there's more debt than there is real estate to finance. And so it's keeping the prices, the cap rates down and the prices pretty high on the real estate. And I think that's going to continue for quite a long time. And so I think that the market will continue to run at where it is for a while longer. I don't know if anyone else has any agree.
And we're on the cusp only of the Chinese capital flows starting to come to the U.S. I looked at a pie chart on the real estate side. I don't know about the debt side so much, but that'll follow. If you look at a pie chart of the composition of real estate investment in the United States in 2012, the name China doesn't show up. Last year, it was about 10% of the pie. And this year, I think there's been $8.5 billion spent since the beginning of 2013, but of that, $6 billion has been spent in the last 12 months, has been invested in the last 12 months. This is a tsunami of capital that's going to come into our country. It's going to grow exponentially. We're on the real cutting edge of it as we sit here today, and the floodgates are opening. So, you know, our biggest counterparties in trade have been Australia and Canada for as long as I can remember. China is going to surpass both of them to be number one this year. And it's only the beginning. And it's an unlimited amount of capital. And so I don't know how, the minute you say you're in a new paradigm is the day, you know, you sort of want to just slap yourself. But I think maybe we are, you know, because we grew up and really, we feared high interest rates and rightfully so. And they rose and they were bad. But now you guys have to figure out how do you live in this low yield, low interest rates, an abundance of capital world, and how does it all get spread around profitably so that you can all make money?
And global volatility is going to keep the demand in the U.S. high for both debt and equity.
Absolutely.
That's
Well,
what you're
rates
seeing.
crashed yesterday and today because of the Ebola and maybe, I think, because of the umbrella revolution in Hong Kong. So,
Any final questions? All right, well, if not, let's give a big round of applause. Thank you so much for